There is a difference between selling because you want to and selling because you have to. The crash you see on your screen right now is not driven by sentiment. It is driven by a change in the fine print. While the mainstream circus is talking about technical levels and support, lines the CME group was quietly rewriting the performance bond requirements for silver futures. They raised the wall to keep the little guy out. This is a classic liquidity flush designed to strip the retail investor of their position right before the real move begins. The math does not lie. This was not a panic. This was an eviction. To understand why your screen is red, you have to understand the mechanism of a margin hike. Margin is not a down payment. It is a performance bond. It is the collateral you must post to stay in the trade. Recently, we have seen an unprecedented series of interventions. Effective after the close of business on February 6th, the CME Group raised initial margin requirements for COMEX 5,000 silver futures to 18% for non-high-risk accounts. If you are flagged as a high-risk profile, that number jumps to 19.8%. Think about the logic of that. In mid-January, they changed the entire system to a percentage-based model. They told you this was to make things more automated and stable. That was a lie. The percentage-based system is an automatic deleveraging machine. As the price goes up, the dollar amount you need to hold your position scales up with it. But that was not enough to stop the rally, so they did something even more aggressive. They raised the percentages themselves. Here is the math of the squeeze. If you are holding 100 contracts and the exchange decides to raise the margin by $3,000 per contract, you do not have a week to find the money. You do not have a day. You need $300,000 in cash sitting in your account instantly. If the algorithm does not see that cash within seconds of the new rule taking effect, it does not matter if you are right about the long-term price of silver. The algorithm sells your position automatically. It hits the bid at any price. This creates a cascade of selling that has nothing to do with supply and demand and everything to do with liquidity. This is how they turn a historic bull market into a record-breaking crash. They are not asking you to sell. They are forcing you to sell. We have just witnessed the most intensive regulatory intervention in silver history. In the span of a single month, the CME Group implemented 5 consecutive margin hikes. Let that sink in. December 12th, December 29th, December 31st, January 28th, and January 31st. They were hitting the kill switch over and over again because the price would not stay down. On January 30th, silver futures on COMEX crashed by over 31% in a single day. It was the largest one-day drop since the Hunt brothers collapse in 1980. Trillions of dollars in market value evaporated in less than 24 hours. The media will tell you the bubble burst. They will tell you that speculative excess was purged. They are ignoring the most critical data point in the entire market. While paper silver was being liquidated in New York, the physical silver market in Asia was telling a completely different story. This is what I call the Great Divorce. During the height of the crash, physical silver in Shanghai was trading at premiums over 50% higher than the COMEX price. While the paper price in the West hit a low near $78, silver on the Shanghai Gold Exchange was going for the equivalent of $120 to $130 per ounce. You are seeing two different prices for the same metal at the same time. One price is set by leverage and paper contracts in a casino. The other price is set by people trading actual atoms. The spread between New York and Shanghai is the largest sustained divergence in the history of precious metals. The arbitrage is obvious, but it is impossible to exploit. The cost of borrowing silver to move it between markets now exceeds the potential profit. The mechanism that is supposed to keep these markets in sync is economically dead. Look at the inventory data if you want to see the truth. According to latest reports, physical silver inventories at the Shanghai Futures Exchange declined from 449 tons to 423 tons in a single week. That is a drop of more than 26 tons of physical metal being pulled out of the vaults. People are not selling their silver in the East. They are taking delivery of it. They are moving it into private storage because they know the paper game in the West is failing. The CME Group and the London Bullion Market Association are no longer reflecting the real price of silver. They have become casinos for wagers. They represent claims on silver that exceed what actually exists in their vaults. Some estimates suggest the paper-to-physical ratio in America is as high as 350 to 1. For every 1 real ounce of silver, there are 350 paper claims floating around the derivative markets. When those 350 people all show up at the same time and ask for their metal, the system collapses. The margin hikes are a desperate attempt to prevent that collapse. By forcing people out of their long positions, the exchanges are reducing the number of people who can ask for physical delivery. It is a way of protecting the bullion banks that are trapped in massive short positions. If the banks cannot find the metal to deliver, they face a catastrophic short squeeze that would force them to buy silver at triple-digit prices. The exchanges cannot let that happen. It would break the financial system, so they raise the cost of holding a long position until only the biggest players can afford to stay. They are clearing the floor so the banks can exit their bad bets. This is a mathematical impossibility masquerading as a market. The demand for silver is not coming from speculators, it is coming from industry. Silver is a critical component in semiconductor manufacturing, renewable energy, and artificial intelligence infrastructure. The world is currently facing a physical silver deficit estimated at 200 million ounces annually. In 2026, that deficit is projected to grow to 293 million ounces. The solar industry alone is consuming massive amounts of silver for photovoltaic production. You cannot print silver to meet this demand. You cannot raise margins to make a solar panel work without silver. The industrial floor for the silver price is rising regardless of what the paper markets in New York say. History is rhyming right now. We have seen this playbook before. In 1980, when the Hunt brothers had cornered the market, the COMEX adopted Silver Rule 7. They restricted margin requirements and declared that trading was for liquidation only. They banned new positions. When the bulls could no longer add leverage to push the price higher, the funding chain broke. The price of silver collapsed from $50 to $10. In 2011, they did it again. They raised margin requirements 5 times in 9 days. The price plummeted 30% in a few weeks. Each time the top was not confirmed by a change in fundamentals, it was confirmed by a change in rules. This round of margin hikes is even more aggressive because the stakes are higher. The CME group is trying to manage what some analysts call a collateral death spiral. The silver rally was being expressed through every possible channel, including tokenized silver futures in the crypto markets. When the margin hikes hit COMEX, it triggered a chain reaction that wiped out $142 million in tokenized silver positions. One single whale on the hyperliquid platform was liquidated for over $18 million in minutes. This forced selling in the digital realm fed back into the traditional markets, creating a feedback loop that amplified the instability. The system is so leveraged that a single point of failure in the margin rules can trigger a global wipeout. You are being told to stay calm. You are being told that this is a healthy correction. But you need to ask yourself who benefits when you sell your position at a 40% discount from the record high. It is not you. It is the banks. They are the ones who need your silver to cover their shorts. They are the ones who want to buy your metal at $70 while it is trading for $130 in Shanghai. This is a shakeout before the breakout. The institutions know that the physical supply is gone. They know that the industrial demand is inescapable. They are using the only tool they have left, which is the margin hike, to shake the silver out of your hands before the next leg of the bull market begins. Look at the Commitment of Traders report. Money managers slashed their bullish silver wagers to the lowest level in nearly 2 years right before the biggest plunge. They were positioning for the rule change before it happened. The smart money knows when the exchange is about to move. They are not guessing. They are participating in the coordination. They reduced their net long positions by 1/3 in the week leading up to the crash. They were moving to the sidelines while retail investors were still buying the top. This is how the wealth transfer works. They build the height, they wait for the leverage to peak, and then they change the cost of staying in the room. The math of the global silver market is currently fractured. We are witnessing a regime change. For decades, the West had a monopoly on price discovery through the paper markets of New York and London. That monopoly is vanishing. If COMEX and the London Bullion Market Association cannot prove they have the physical metal to back their contracts, they will be forced into cash-only settlements. If that happens, they are no longer an exchange. They are a casino. At that moment, the benchmark for silver will move to where the metal is actually traded. It will move to Shanghai. It will move to the India International Bullion Exchange in Gift City. The silver divorce between East and West has officially begun. Do not be fooled by the red numbers on your screen today. The price you see is the paper price. It is the price of a promise that may never be kept. The real price is the one you have to pay to get a silver coin in your hand. The premiums are exploding. The US Mint recently repriced silver eagles with an 86% increase in the middle of the crash. The Perth Mint in Australia suspended wholesale orders because they do not have the metal to sell. This is a physical squeeze masquerading as a paper sell-off. The system is trying to hide the shortage by suppressing the price. You have a choice to make. You can be a creditor who holds a piece of paper and hopes the bank honors its promise. Or you can be an owner who holds the physical asset that the world actually needs. The banks want you to be a creditor. They want your leverage, they want your margin payments, and when the time is right, they want your forced liquidation. They are selling you a promise they cannot keep, and they are using the CME group to ensure you are the one who pays the bill. The shakeout is here. Trillions have been wiped out, and the media is dancing on the grave of the silver bull market. But if you look at the plumbing, if you look at the inventory in Shanghai, if you look at the industrial demand floor, you will see that the bull market is not dead. It is being purged of leverage. This is a painful reset, but it is a necessary one. The system is clearing the deck for the next phase. The banks are trying to get on the right side of the trade before the real move begins. Do not let them take your position. The math of the physical market is inescapable. The rules can be changed, but the atoms cannot be printed. The system is failing, and the margin hike is its last line of defense. Listen to the data, not the headlines. The math does not care about your feelings, but it also does not lie. We are watching the end of the paper game. Build your ark. Load it with hard assets. The storm is not over. It is just getting started.